I'm going to refer to the long-short fund presentation that was lodged on the ASX yesterday. I know it's going to be a busy day for everyone, but if you do have time, I think we've put a huge amount of effort into this pack, and particularly given the news today, I think it's quite topical. So hopefully that's of interest to everyone. So turning to the pack on page 4, the L1 long-short strategy, so I'll refer to it as LSF through the presentation, has performed really strongly since March. The NTA has increased by roughly 70% from around $1.08 on March 23 to around $1.83 as of November 4. We continue to be positioned for very strong equity markets. I think it's the most bullish that we've been on equities since the absolute depths of the GFC. You know, Raf and I have been in markets almost 20 years. We think this is one of the best backdrops we've ever seen for equities. We expect there to be a major rotation towards value and cyclical stocks, and obviously we saw a lot of that last night. We think there's a lot of drivers for rotation to cyclical stocks. I think the most common question that I get when we tell people our view is, yeah, but why are cyclicals going to perform now? Or why are value stocks, everyone's been crapping on about value stocks for years and years. Why is it going to happen now? And I think there's a few major things that are different about this event and this timing than there've been before. Firstly, the vaccine is by far the biggest news that is going to dominate markets. It's far more important than the US election. It's far more important than COVID case numbers. The vaccine is massive. 90% effectiveness is a game changer. That's the same level of efficacy as vaccines like the smallpox vaccine, which has basically been eradicated. So this is something that's going to ensure herd immunity globally, and the fact that the Pfizer vaccine worked suggests that it's very likely that the other vaccines will work as well, because they produce the same neutralising antibodies. That's a massive positive. Second one is that you've got the most extreme monetary and fiscal stimulus that we've ever seen. This is more fiscal stimulus and more monetary stimulus than we saw during the GFC. And that's going to cause one thing, and that's asset price inflation. And the third thing is you're already seeing leading economic indicators start to improve, and you've got incredibly cautious and defensive investor positioning because of understandable concerns about COVID-19. So you've got this confluence of events that we think is going to cause a major inflection point in markets. This is not, we don't believe this is going to be a one-day trade. We think this is going to be an enduring 6 to 12-month rotation as people are totally not positioned for this move in markets and this stronger economic activity. We think there are 4 broad areas of opportunity in the market that have a fantastic risk-reward. The 4 areas are monopoly real assets, COVID-19 losers, depressed commodities, and demergers and restructures. And we have a separate section in the presentation on that, but I don't propose to go through that in the interest of time today. Lastly, the board has enacted a very large and aggressive share buyback program, which has significantly closed the discount to NTA. You know, back in February, March, the discount had blown out to around 40%. The board decided to put in place a buyback program and has been incredibly aggressive in doing that buyback. And the discount has reduced from around 40% to less than 15%. And the board's been very clear that it will continue that aggressive buyback program until the discount reduces to less than 10%. So we've been really pleased with the effectiveness of that. And you'll see later on in the presentation, there's a number of other measures we've put in place to make sure that NTA starts tracking with the share price much more closely. And lastly, the investment team has again substantially increased their investment in LSF. We couldn't be more positive on the outlook for LSF. We think that the portfolio looks as good as it's ever looked. And I know that we let people down in 2018, but hopefully people have seen both in 2019 by being up 25%, also buying the market aggressively back in March. And then again, obviously with this vaccine news and the positioning we've got, we think that we're incredibly well placed to perform going forward. And that's why the investment team bought around $10 million of stock PA after the full year results in August and September. The fund's had really good performance in 2019 and again in 2020. Even though we're a value investor and we've got a contrarian bias, we've outperformed the market in 2019 and we've outperformed the market again so far in 2020, and that's with an absolutely massive headwind. The strategy has returned 15.8% per annum net since inception compared to 5% for the ASX 200. We put that in there not to annoy LSF investors. I understand that some LSF investors get frustrated when we say that because they haven't enjoyed those returns. We don't do it for any other reason than to let people know what's possible from this investment team and this strategy over the long term. We've done triple the ASX 200 returns with the biggest headwind for value investors that we've ever seen in the last 50 years. So if people believe that you're going to see a slowdown or an inflection point in that headwind in terms of value and contrarian investing, hopefully it gives people a sign of what this team is capable of if we're on our game. There have been 4 reasons for the strong performance since March. The first one is that we bought or added aggressively to numerous oversold stocks at the March lows. Transurban, Qantas, Tabcorp, Oil Search, Downer, Centre and Star Entertainment. And then in the small cap space, a lot of stocks that you guys would be very familiar with, Lovisa, Webjet, HPI, ALS Limited, Karoon and Eclipse. All of these positions have increased a lot since March, but we believe there's a lot left in the vast majority of them. I just mentioned that we've exited Transurban from that list, and we've also exited ALS Limited, but we believe we've also exited HPI, but we believe that the balance of those stocks still look incredibly attractive even at today's prices. Back in March, when everyone was panicking and most people were liquidating their share portfolios, we increased our net long by more than 30 percentage points and took our net long to the highest level in the history of the long-short strategy. We thought that was the best buying opportunity that we've seen in the last decade, and we continue to believe that the market looks incredibly attractive. People who are invested in bonds or cash or property, I can't understand why you would possibly want to be in those asset classes when you compare it to the outlook for equities. Far better returns. You're not even getting inflation if you're investing in bonds or cash. So in our view, equities look phenomenal at the moment. And for context, we've been relatively, unexcited about equities for a number of years. But in the last 6 to 12 months, since the COVID crash, we've become incredibly positive. Back in March, we also closed 10 of our short positions at the March lows from 34 shorts to 24, acted very decisively. And we also had one of the best periods of stock picking for the fund. We picked the number 1 or number 2 performer across a bunch of different sectors. As I was saying, we think equities look really attractive. The fiscal stimulus and monetary stimulus is extreme, and it's likely to cause further asset inflation. Investor positioning is incredibly cautious because of the concerns around COVID-19, but we believe the outlook for COVID-19 is going to improve, and I think any doubts that people had about whether that was going to happen or not should be totally allayed based on what was announced last night from Pfizer. Over 90% effectiveness is a game changer. And then lastly, we've seen a strong rotation into value and cyclical stocks last night, and we think that's going to continue because of just how far they've lagged in 2020, and the inflection points being the vaccine and also likely stimulus in the US. As you can see on the chart on the right, this shows the relative performance of value versus growth stocks over the last 50 years. An incredibly long time frame to consider the relative performance of value and growth stocks. As you can see, growth stocks have massively outperformed over the last 13 years, but particularly over the last couple of years. And unfortunately, the timing of the long-short IPO exactly coincided with the acceleration of that trend. You know, we're a value and contrarian investor. It has been by far the toughest environment to invest with that strategy that I've ever seen in my sort of 18 years in markets. The current period of underperformance of value stocks is by far the largest and longest of the last 50 years. There has never been a period like it. Even the dot-com boom of 2000 looks like a small move compared to what we've been through over the last few years. Factor dispersion, which is measured by Morgan Stanley's US growth basket, which is up 41% for the year, compares to their US value basket, which is down 55% over the same 10-month period. That's a 96 percentage point difference in a very wide basket of stocks. That is off the charts in terms of historical performance. LSF performance has been very strong in 2019 and again in 2020 despite this headwind. We think that if you see any stabilisation or reversal of this trend, you would expect to see a major positive inflection point in LSF performance. It's a very busy slide, but essentially the key message of this slide is all of the factors and sectors you can see on the left-hand side of this chart are trading incredibly expensive versus their decade average, and all the factors and sectors on the right-hand side of this chart are trading incredibly cheap versus their decade average. High PE growth stocks have never been more expensive in the past decade, and low PE value stocks have never traded cheaper in the past decade. That's a pretty amazing statement. We're not suggesting that every single low PE stock is a buy and every single high PE stock is a short. We recognise that there are value traps in the low PE stocks and there are structurally advantaged companies on the flip side in the growth stocks. But what we're saying is that there's an extreme in markets and that there are lots of value stocks today that look attractive and there are lots of growth stocks that look expensive. And our job as fundamental investors is to identify which are the really good opportunities within that basket. And the nice thing for us is there are lots of great opportunities to look through. Back in our March presentation, we talked about a number of stocks that we believed were incredibly oversold and had a lot of upside as the impact of COVID-19 moderated over time. All of these shares have rallied strongly since March, with the one exception of URW, and we see substantial further gains ahead. In most cases, we believe that the lasting impact of COVID-19 on these companies will prove to be manageable, and even if there was only a partial recovery, it would deliver strong returns. In most cases, we think there's actually going to be a full recovery, and in some cases, even better than a full recovery because of cost-out programs that have occurred. So people who are looking at share price, like say a company like Oil Search that always used to trade at $7, and even allowing for a capital raise that might be trading as the equivalent of $5.50, there's 100% upside to the Oil Search share price if you believe the oil price is going to normalise. So these are not small moves that are possible. We think there's a huge amount of upside in a very wide range of these bombed out COVID-19 stocks. Essentially, the vaccine news overnight is consistent with what we were expecting. So we've been expecting a positive data point from at least one of the Western world vaccine candidates in November, December. We're incredibly pleased with the data that came out overnight. So for anyone who didn't see it, the Pfizer data said that the efficacy of their vaccine is more than 90%. So that puts it up there with the most effective vaccines of all time. So things like the smallpox vaccine, the measles vaccine, they're in the mid-90s. Pfizer's saying over 90%, so we don't know exactly how much over 90, but this is a massive validation of their trial. It was a huge trial, 40,000 people involved. The Moderna trial, which we expect to see data in December, that's a 30,000 person trial. So these are large-scale trials in very large population samples that we think the data is incredibly robust. There were also no safety issues. So it's about as perfect as you could get in terms of the vaccine data. In the interest of time, I won't go through the treatment and testing stuff, but I'm happy to talk to people about that offline. To give people context, this wasn't like a random guess, us positioning the portfolio for the vaccine. We did more than 100 meetings with everyone who matters globally on COVID-19. We did meetings with the CEO, Chief Scientific Officer, Head of R&D at every single vaccine company globally. So this was by far the biggest research effort that we've ever done at L1, and we couldn't be happier with the way that things have played out exactly as we had expected. What's amazing to us is exactly what was being said in the introduction, that the majority of fund managers thought that it was likely that a vaccine would come, but what's amazing to us is that the share prices of these COVID-19 stocks didn't reflect that. They reflected that there's going to be a permanent and large reduction in the profitability and cash flow of these businesses, and that's just definitely not going to be the case. If this vaccine works, there's no way you're going to see a halving of the profitability or cash flow of these businesses. In many cases, they can re-emerge even stronger because the competitive landscape has improved.